If you've ever tried to read about investing, you've probably seen the word index fund thrown around a lot. Some people talk about it like it's the sensible, boring option. Others talk about it like a cheat code. But what actually is an index fund in normal English? And why do so many people keep saying things like, just buy the index, or you don't need to pick stocks? Welcome to Money for People. My name is Derek, and here we explain money and investing in plain English, so normal people can actually understand it. In previous videos, we've talked about what investing is, what risk is, what a stock is, and how inflation works. In this one, we're going to put a few of those ideas together and talk about index funds, what they are, how they work, why a lot of normal investors use them, and what they do not magically solve. This is for education only, not financial advice. Let's start with the simplest piece. Part 1. What is a fund? A fund is just a pot of money that belongs to lots of different investors, not just one person. Instead of you buying individual investments on your own, you and many other people put your money into the same pot, and that pot then owns a whole collection of things. Think of a fund like a big shopping trolley. Instead of you buying just one item and walking out of the shop, you and thousands of other people all put your money into the same trolley. That trolley is then filled with lots of different things. Different companies' shares, maybe some bonds, maybe other assets, depending on the type of fund. Each investor owns a slice of the trolley, not just one item. That's the basic idea of any fund, a shared basket. You put money in, the fund spreads it across lots of investments, and you own a small share of whatever the fund holds. If the basket does well overall, your slice becomes more valuable. If the basket does badly, your slice falls in value too. Now, index funds are a specific type of fund. To understand them, we need to talk about what an index is. Part 2. What is an index? An index is not a product you buy. An index is more like a list or a scoreboard. In the UK, one of the best known indexes is the FTSE 100. That's simply a list of 100 of the biggest companies whose shares are traded on the London Stock Exchange. There are many other indexes in the UK and around the world. Some track big companies, some track smaller ones, some track specific regions or sectors. An index does not hold money. It doesn't make decisions. It's just a way of keeping track of how a group of companies is doing as a whole. When you hear people say, the market was up 1% today, or the market fell, they're usually talking about an index moving, not every single share in existence doing exactly the same thing. Think of an index like the league table in football. The table itself doesn't play any matches. It just records how all the teams are doing together. If most teams are winning, the table reflects that. If lots of teams are losing, the table reflects that too. In the same way, if most of the big companies in an index are doing well, the index tends to rise. If many of them are struggling, the index tends to fall. So, if a fund is a big shared trolley and an index is a list or a scoreboard, what happens when you put those two ideas together? You get an index fund. Part 3. What is an index fund? An index fund is a fund that tries to copy an index. It takes the shopping list from the index and tries to hold those same companies in roughly the same proportions, rather than trying to be clever and pick winners. So if an index is these 100 companies in these weights, then an index fund is, we will build a fund that owns those 100 companies in roughly those weights. If the index goes up, the index fund should move in a very similar way. If the index goes down, the fund goes down with it. It is not trying to beat the index, it is trying to match it. This is sometimes called passive investing, because the fund is not constantly trading in and out of positions based on opinions about each company. It is just following the index rules. There are index funds that track broad UK markets, like the FTSE 100 or FTSE 250. Global markets, like world indexes. Specific regions, like the US or Europe. Specific themes, like large companies or small companies. In all cases, the basic idea is the same. Follow the index rather than trying to outsmart it. Now, why do so many people like index funds? Part 4. Why do people use index funds? There are a few simple reasons that index funds are popular with normal investors. First, diversification. When you buy an index fund, you're usually spreading your money across tens, hundreds, or even thousands of companies at once. You're not relying on one company or one small handful of picks to carry your whole future. If one company struggles, it is usually only a small part of the overall fund. Second, simplicity. You don't have to research every individual stock. You don't have to guess which manager will outperform. You just decide which broad market or index you want to track, and the fund does the rest. Third, cost. Because index funds are following a set of rules, rather than paying large teams of people to pick stocks, they often have lower ongoing fees than many actively managed funds. Lower fees don't guarantee better outcomes, but they mean less is being skimmed off each year, which can make a big difference over the long term. Fourth, alignment with how markets behave over time. Over long periods, many broad indexes have grown as economies and companies have grown. Index funds allow you to ride along with that general growth, without having to predict which specific company will do best. Of course, index funds are not magic. There are risks and limitations, and it's important to understand those too. Part 5. Risks and how to think about index funds. Index funds are still investing in the stock market. That means they can go down in value, sometimes sharply, especially over short periods. If the index they track falls by 20%, the index fund will fall by roughly that amount as well. There is no protection built into the structure just because it's an index fund. They also don't avoid the problem of inflation. If the market you're tracking has a long, weak period, or if inflation is very high, your real returns can still disappoint. Another thing, an index is only as broad or as narrow as its rules. A UK-only index fund is heavily tied to the fortunes of UK companies. A global index fund spreads your risk more widely, but you're still following a particular definition of the market. There's also the emotional side. Because index funds track the market, you will see them move up and down with every bit of good or bad news. They are simple to own, but not always easy to watch, especially if you check them constantly. So an index fund is not a guaranteed result, a replacement for an emergency fund, or a way to avoid risk altogether. What it is, for many people, is a straightforward tool to spread risk across many companies, to keep costs relatively low, and to participate in long-term market growth without constantly having to make decisions about individual stocks. The key is matching the tool to the job. Index funds are usually used for long-term goals, with money you can leave invested for many years, not cash you might need next month. Let's quickly recap. A fund is a shared pot of money that owns a basket of investments on behalf of many investors. An index is a list or scoreboard that tracks how a particular group of companies is doing. An index fund is a fund that tries to copy an index rather than trying to beat it. It holds the same kinds of companies in similar proportions and aims to move broadly in line with that market. Many people use index funds because they give diversification, simplicity, and often lower fees than some actively managed options. But they still go up and down with the market, they still involve risk, and they are not a substitute for cash savings for short-term needs. If you understand what an index fund is actually doing, you're less likely to be surprised later by how it behaves, and more likely to use it in a sensible way as part of a bigger plan. If you found this helpful, you can subscribe to Money for People for more simple videos about money, investing, and how it all works. This video is for educational purposes only and is not financial advice.